2026 is not just another year. It's a year of a lot of changes and also a year of a lot of opportunities. And one of those biggest changes is the One Big Beautiful Bill, the new tax bill that was passed in July of 2025. That new tax bill had a lot of changes, some of which were retroactive to 2025, but some of which are taking place and taking effect now starting January 1 of 2026. If we look at some of those kind of key provisions that were part of that bill, one of them is a new senior deduction. So those of you who are over the age of 65 will now receive an extra $6,000 deduction that goes on top of either your standard or itemized deduction. Also, if you receive overtime or tip-based wages, those may also be tax-free. Charitable deductions are changing a little bit. There's now a new charitable deduction starting in 26 that'll go on the front page of your 1040, where you'll be able to get some advantage for giving to charities, even if you don't itemize. But many more of you may actually itemize because the state and local tax deduction, better known as SALT cap, that was capped at $10,000 historically, has now been raised to $40,000, allowing you to have a bigger deduction for those property taxes or state taxes that you pay throughout the year. Some of these tax provisions, though, are set to expire at the end of 2028. So there's a limited planning window that you need to take advantage of, and making sure that you're proactive about 26, 27, and 28 to make sure that you take advantage of all of these opportunities. This is especially true if you are what we call an early retiree, meaning that you're retiring before age 65. A lot of these different provisions have an impact on you in making sure that you take advantage of this window. But there's also another impact that the One Big Beautiful Bill had on you, and that is the removal of the enhanced subsidy credits. Now, the One Big Beautiful Bill didn't talk about this directly, but the fact that it was silent meant that the enhanced subsidy credits expired at the end of 2025. What this means is the rules become stricter and you need better planning to make sure that if you need health insurance before Medicare age, that we're doing good tax planning and making sure that you're falling in these strict brackets to make sure that you qualify appropriately. Another key theme for 2026 is that of longer retirements. People are living longer, and many times people are retiring early, especially if you've retired before age 65. You may have 3 or 4 decades of retirement to plan for. And this requires a proactive plan. And this takes into account a lot of different variables, one of which is interest rates. Interest rates are still reasonably high today, but they have been falling over the last year and are expected to fall further. Also, you don't want to chase returns. The stock market's done reasonably well these last few years, and it's really tempting to take on more risk or to chase that asset class that did really well last year. But making sure that you have a sound investment strategy that doesn't overexpose you to risk is also key. And there's a few key decisions for everybody that they need to look at over the course of 2026. Some of these are things like Roth conversions, making sure that you take advantage if you should do Roth conversions. Sometimes they're oversold, but many times there's an opportunity with lower income or higher deductions to do some Roth conversions. Making sure that if you're retired, that you're taking money out of the right accounts, that you're withdrawing money from the right accounts to keep you in the right tax brackets. If you're nearing Social Security age, making sure that you take the right Social Security benefit at the right time to maximize your lifetime benefits. And for healthcare, even for those post-65 who are on Medicare already, there's something called IRMA, that if your income jumps to be too high, you're going to get an extra Medicare premium charge that sometimes can double the cost of what you've been paying historically. And so making sure that you pay attention to all of those things over 2026 is important. And many of those things have a calendar-based deadline. There are some decisions that you can loop to the next year's tax filing deadline. So think like IRA contributions or HSA contributions, you can wait to make those decisions until April 15th of the next year. But many of the things that you get deductions for, think charitable deductions, or things that determine when you recognize income and how you recognize income, need to be done before December 31st. And while December 31st may seem like a long ways away, making sure that you plan starting today gives you the best time to make sure that your plan is proactive, takes into account the different variables, and make sure that you have a successful retirement. One of the key things also is working with an advisor who has expertise in these areas. And us at Straight Path, we specialize in retirement, and specifically people retiring before age 65. And so if you're looking for a second opinion on your plan or your portfolio, or just feel like you need more proactive advice to make sure all of these variables are taken care of, please feel free to reach out to my team directly or schedule your free assessment on our website.